I'm the hamster narrator, and today tariffs are like a paid turnstile at the border that charges a fee on every sack of grain. And sometimes that single turnstile scares markets more than a scary headline because it hits prices and expectations immediately. A tariff is basically an import tax, meaning a tax on goods coming in from another country. The moment a product crosses the US border, the importer must pay a percentage to the government, which automatically makes that import more expensive. Here's the key detail. The tariff isn't paid by some abstract country, it's paid by a real importer, a hamster with paperwork who hands the fee to customs. And then part of that extra cost often gets moved into the price tag, which means the shopper ends up paying. It's simple math. If something costs 100 seeds and the tariff is 10%, it becomes 110 seeds. You can ignore politics completely, but you'll still see it right there on the shelf in the store. Trump often calls them reciprocal tariffs, meaning if they tax us, we tax them. The logic is straightforward. Let's level the playing field so the rules aren't tilted. Supporters usually give two main reasons. First, protect American jobs and bring factories back so wage seeds don't flow overseas. Second, use tariffs as a negotiation lever. Sit down and deal, or your goods get pricier here. When production leaves, what's left behind can be empty plants and rusted signs, the Rust Belt experience. In hamster terms, the barn is closed, and the seeds are now stored in someone else's warehouse. Over the long run, U.S. manufacturing employment has looked like a slide downward, and that fuels the emotion behind bring manufacturing home. People argue about the causes, but the picture is easy to read. Fewer jobs at the machines. Now, the trade deficit, it's when a country buys more from abroad than it sells abroad. In hamster language, we carry more sacks of grain out of the house than we carry back in. According to the BEA, the U.S. trade deficit in goods and services for 2024 was about $918.4 billion, which is a huge number for political messaging. That's why tariff supporters frame it as, we're buying comfort today and sending the bill overseas. Month to month, the trade balance wiggles. Better, worse, better again, like a hamster's cheeks filling and emptying. But the overall story still feels negative, and politicians hate that. So tariffs become a club. If you won't negotiate, I'll make your product more expensive in my market. Sometimes the threat alone moves people, because everyone starts counting seeds as soon as deadlines appear. In January 2026, Reuters reported that Trump tied tariff threats to Greenland and promised duties targeting 8 European countries. When trade gets mixed with geopolitics, markets usually tense up even more. On the map, it's simple. Greenland sits on a strategic Arctic crossroads, while nearby allies don't want pressure by force. That's why this story is full of maps, arrows, and red markers. The Reuters report described a clear timer, 10% from February 1st, 2026, and potentially rising to 25% by June 1st, 2026, if no deal happened. Markets hate timers because they turn rumors into hard deadlines. Supporters frame it through security. The Arctic matters more, and competition with Russia and China is growing there. In their logic, Greenland is a northern door you don't want left unguarded. The U.S. already has the Patuxent space base in Greenland, often discussed in early warning and space surveillance terms. For a viewer, the simplest translation is a northern eye that can see far. There's also the shipping angle. As ice retreats, Arctic sea routes become more practical, and those lines on the map come alive. Whoever controls key nodes can save time and money seeds on every trip. And then there's resources. Greenland is discussed for critical minerals used in technology and defense. In hamster terms, it's rare premium seed that makes the motor spin. Now, the China factor. Production of rare earth magnets is highly concentrated and China dominates, according to IEA charts. That's why tariffs are sometimes pitched as a way to reduce a risky dependence on one barn. Let's talk markets. When trade war vibes appear, investors often go risk-off. They sell what can drop fast and move seeds into safer burrows. Bitcoin is often treated as a risk asset, so hard trade headlines can hit it quickly and sharply. Algorithms react to a headline faster than a human can blink. Then you get the domino effect. Some traders use leverage, price drops, exchanges liquidate positions, and the fall accelerates. In hamster terms, one shove in a crowded line and everyone tumbles down the stairs. At the same time, so-called defensive assets often catch a bid, and Reuters linked jumps in gold and silver to Greenland-related tariff threats. The contrast can be brutal. Risk assets down, safe havens up. That's where the weird paradox comes from. Digital gold can fall while real gold rises on the same day. In panic mode, people buy sleep, liquidity, and stability, not dreams. The biggest argument about tariffs is inflation. Will prices rise for ordinary people, or will production shift and stabilize things? One side says it's a tax, so it's more expensive, and the other says it's an incentive to build locally. The prices rise camp points to research on the 2018 tariffs. In many cases, the costs were largely passed through to importers and consumers via higher prices, meaning the foreign country rarely pays for you. You usually pay, just in a different line of the receipt. A concrete example is sugar policy. U.S. quota and tariff systems have long been described as keeping domestic sugar prices above world prices. That's a border barrier turning directly into a higher grocery bill. Another example that made headlines is baby formula. After temporary relief measures, imported formula could face tariffs again. For families, that doesn't sound like trade policy. It sounds like the can cost more. Trump's team and supporters argue the opposite path. If you make the product inside the US, the tariff doesn't apply. In the best case, that encourages domestic competition and can cool prices over time. But a factory doesn't pop up overnight like a mushroom after rain. You need planning, building, hiring, and supply chains. So, in the short run, tariffs can push prices up faster than new production can arrive. There's also the money layer. Inflation depends not only on tariffs, but on the amount of money in the system and central bank policy. If the economy gets flooded with new seeds, prices can rise even without border fees, and tariffs just add another weight. Now, China again. Critics argue China subsidized industries and created overcapacity, meaning too many cheap goods flooding global markets. In domestic politics, that becomes, we're being undercut, so we need protection. IEA data also shows China as the dominant EV production hub, with over 70% of global electric car production in 2024. That's impressive efficiency, but it also amplifies worries about dependence if the supply chain is too concentrated. Rare earths, magnets, and processing are an even tighter bottleneck because they power EV motors and support parts of defense tech. That's why tariffs are often justified not only as economics, but as, we don't want to be addicted to one supplier. So supporters sell tariffs as supply chain insurance. Pay more now, build your own barns later, become more resilient. Like storing seeds for winter, painful to save, but it helps you sleep. Opponents warn about retaliation. Other countries can respond with their own tariffs. Then trade becomes tariff ping pong, and businesses and consumers pay through higher prices and disruptions. Who wins? The government collects revenue, and some industries get a temporary shield. Who loses? Often consumers and firms that rely on imported parts, because the border fee becomes a direct increase in cost. If you want to follow the story without noise, watch 3 dashboards: tariff announcements, the trade balance, and market reactions in risk-on/risk-off mode. And remember, crypto loves calm liquidity. Trade wars bring volatility. My hamster conclusion: tariffs are a simple tool with expensive, sometimes surprising side effects. Protect your seeds, don't panic over a headline, and always ask, who actually pays? And when does it reach the price tag?